London didn't become the financial capital of the world because a mountain of colonial gold landed on a dock and magically turned into a stock exchange. That story sounds neat, but it's too simple, and it misses the real plot twist. The truth is more subtle, more human, and honestly more unsettling. A quiet legal rule changed how ordinary people thought about risk, blame, failure, and second chances, and it rewired the flow of global money toward one city. Tonight, I want to show you the overlooked switch that helped London become the place where the world came to borrow, insure, invest, and build, often without ever setting foot in Britain. In the early 1800s, London was important, sure, but it wasn't destiny. Other cities had worn the crown before: Amsterdam, Venice, Paris, and lost it. Finance is loyal to one thing only: trust. And trust doesn't come from vibes. Trust comes from rules, boring, stubborn rules, backed by courts, paperwork, and the kind of predictability investors can sleep on. So let's start with a simple question that sounds small, but changes everything. What happens if a business fails? Not the business. You. If you invest in it, if you join it, if your name is attached to it, do you lose your money, or do you lose your life savings, your home, your future, and your family's stability too? For a long stretch of history, the answer was brutal. If the business collapsed, the debt could chase you personally. Not just the money you put in, everything you owned. And once you feel that danger in your bones, you don't invest casually. You don't take chances on big projects. You don't fund strangers. You keep wealth close, you lend only to people you know, and you build slowly. If you build at all, that's the part people forget. Big financial centers aren't built on money alone. They're built on the willingness of people to take risks together. And for that, people need a rule that tells them, if this goes wrong, you will not be ruined beyond recovery. In mid-19th century Britain, Parliament made a choice that sounds technical, even sleepy, but it was revolutionary: limited liability. In plain English, limited liability means this: if you buy shares in a company, the most you can lose is what you paid for those shares. The company can fail, but the creditors can't come for your house just because you invested. This wasn't always normal. It had to be invented, debated, and forced into the legal system because some powerful people thought it was immoral. They believed limited liability would encourage recklessness. And to be fair, they weren't entirely wrong. But that's what makes this story so human. It's not about a perfect rule. It's about a rule that changed behavior. In 1855, Britain passed the Limited Liability Act, opening the door for limited liability for certain joint stock companies in England, Wales, and Ireland. Then reforms continued, especially with the Joint Stock Companies Act of 1856, which helped make forming these companies easier and broader. If you're thinking, okay, why would that make London the financial capital of the world? Stay with me, because the real impact wasn't a law book. The impact was psychological. Picture a careful middle-class saver in Victorian Britain, not a billionaire. Just someone who worked hard, put money aside, maybe ran a small shop, maybe inherited a bit, maybe hoped to give their kids a better life. Before limited liability, investing in a big company wasn't just a financial decision. It was a moral gamble with your entire identity. One bad investment could turn you into a cautionary tale. But limited liability changed the emotional math. Suddenly, a person could say, I'll risk this amount, but not my whole life. That's the moment investing stops being only for the ultra-rich and the ultra-connected. That's the moment capital begins to pool. And once capital can pool safely, something incredible happens. Projects get bigger than families, bigger than guilds, bigger than local networks. Railways, steamship lines, mining ventures, insurance empires, telegraph companies, banks that can finance trade across oceans. All of it becomes easier when thousands of people can contribute small pieces without risking personal annihilation. So London didn't just become a place where money sat, it became a place where money could be assembled. And in finance, assembling money-turning scattered savings into focused power is everything. This is where the story gets quietly global. Because Britain wasn't only building within Britain, London was becoming a fundraising machine for the world. Capital raised in London could finance a railway in Argentina, a port in India, a mine in South Africa, a shipping fleet crossing the Atlantic, without every investor needing to know the operator personally. Limited liability helped convert trust in a person into trust in a system. But there's another layer here that matters. Limited liability wasn't a magic spell on its own. It worked because it plugged into something else Britain had been building, a legal and financial environment that outsiders could rely on. If you're a foreign merchant, or a distant investor, or a trading house trying to finance shipments across continents, you're not just asking, "Can I make money?" You're asking, "If something goes wrong, do I have recourse? Are contracts respected? Are the rules understood? Will courts enforce them consistently?" London's rise was helped by the way English commercial law traveled across borders, not by conquering everyone's wallets, but by becoming the default language of deals in many parts of global finance. And when a city becomes the place where contracts are written, disputes are settled, and standards are recognized, it becomes sticky. Money like sticky. Now, let's talk about one of the most powerful engines of London's dominance, trade finance. In the late 1800s and early 1900s, the London market for bills of exchange sat near the center of global trade, short-term lending and borrowing that kept goods moving across oceans. If you've never thought about it, trade is expensive before it's profitable. A shipment of goods can take weeks or months to arrive. Someone has to front money for production, transport, storage, and risk. Bills of exchange became a key tool for bridging that gap, and London became the place where these bills could be accepted, guaranteed, and turned into liquid money fast. Institutions known as accepting houses specialized in guaranteeing bills, helping strangers trust each other across distance and uncertainty. That meant global trade could run through London's financial bloodstream even when the physical goods never touched British soil. To make this system work at scale, you need rules that are clear enough to be trusted widely, and Britain codified key principles in the Bills of Exchange Act of 1882, which helped standardize and clarify how these instruments worked. Again, it sounds dry, until you realize what standardization really means in finance. It means you can trade trust like a commodity. So by the time the world entered what some historians call the first era of modern globalization, London wasn't just rich, it was functional. It was the place where global trade credit could be priced, bought, sold, discounted, and insured with speed. And now we hit the heart of the "not colonial gold" argument. Gold is a resource. It can be looted, mined, shipped, stored, spent. But gold doesn't automatically create a world financial capital. A financial capital is built when strangers believe that paper promises will be honored, that risks can be shared, and that failure won't lead to chaos. Limited liability was a quiet promise written into law. You can participate in ambition without being destroyed by it. But here's the part we have to face honestly. Limited liability also carries a shadow. When people don't bear the full cost of failure, some people will take bigger risks. Some will hide risk. Some will gamble with other people's money. That's not a British flaw. That's a human flaw. Over time, every financial system learns the same lesson. The more you protect investors from total ruin, the more you need guardrails, disclosure rules, auditing standards, capital requirements, and regulators who understand the games people play. This isn't ancient history. You can feel it echo through modern finance. Limited liability is part of why you can buy a stock today with a tap on your phone. It's also part of why corporations can become so powerful that their failures hurt workers, communities, and entire economies. That's why when I look at London's story, I don't see a clean fairy tale. I see a trade-off, a bargain. Britain helped unlock large-scale investment by limiting personal ruin, and then spent generations trying to manage the behavior that unlocked. So what about London today? Did Brexit end the story? Did the crown move permanently? The reality is messy, but one thing is clear. London is still one of the world's top financial hubs. In widely watched rankings like the Global Financial Centers Index, London has continued to place near the top, frequently trading spots with New York. The index is updated twice a year, and recent editions still show London in the top tier globally. And even in the latest public database surveys, London continues to score extremely high across categories like professional services, market depth, and global connectivity. But the competition is real. New York, Singapore, and Hong Kong aren't standing still, and newer challenges like Dubai keep pushing. What's also real is that the UK has been actively trying to keep the city competitive, adjusting rules, modernizing frameworks, and debating how much regulation helps versus harms. Recent discussions have included proposals to ease certain regulatory burdens in areas like financial benchmarks, part of a broader push to keep London attractive for global business. So London's position is not just a trophy from the past, it's a living contest. And this is where I want to bring it back to you, because if you're watching a channel like Simple Financial Insight, you're not here just for trivia, you're here because money decisions shape real lives. London's rise teaches a personal lesson that's easy to miss. Your financial future depends on the rules beneath your feet, not just interest rates, not just stock charts. The legal structure of investing, how ownership works, what you're liable for, what happens in bankruptcy, what protections exist, those boring details decide whether people feel safe enough to build. That's why I always tell people before you chase returns, understand risk. Not fear. Risk. Know what you can lose. Know what you can control. Diversify. Don't confuse a rising market with personal genius, and never stake your entire life on a single bet you don't fully understand. Limited liability made it possible for millions of people to invest without risking everything. But it didn't remove danger, it just reshaped it. Today, you can still get wiped out through leverage, through concentrated positions, through scams dressed up as opportunities, through hype that fades the second reality hits. The difference is now the danger isn't usually a creditor taking your house because a company failed. The danger is you taking your own future hostage because you believed a story you wanted to be true. And that's why stories like London's matter. They remind us that the world's biggest financial centers aren't built only by winners. They're built by systems that convince ordinary people to participate. Participation is the fuel. Trust is the engine. And laws, quiet, technical laws, are the bolts that keep the machine from flying apart. Before we close, let me give you one more emotional truth. Most people don't avoid investing because they're lazy. They avoid investing because, deep down, they're afraid. Afraid of looking stupid. Afraid of losing what they worked for, afraid of a mistake they can't undo. Limited liability didn't erase fear, it simply gave people a boundary, a line that said, you can try, you can learn, you can survive the lesson. If you take anything from this documentary, let it be that you don't need to be fearless, you need to be structured. You need rules in your own life, the same way a financial capital needs rules in a legal system, limits, safeguards, clarity, and the humility to prepare for the day things don't go your way. And if you want more stories like this, stories that connect history to real-life money decisions without hype, without jargon, and without pretending any of this is easy, then take a second and subscribe to Simple Financial Insight. It helps the channel grow, and it tells me you want more deep, human financial storytelling, the kind that respects your time and your real life. Because at the end of the day, the world's money capitals don't matter as much as your home, your future, and your peace of mind. And the best financial rule you can ever adopt is simple. Learn before you leap and make sure any leap you take won't destroy you if you land wrong.